Mr. Mark Selby. How are you, sir?
Good, Mr. Matthew Gordon. Nickel is trading again on the LME, so it's nice to see. Well, it trades for about 4 minutes a day and then hits its lower limit and then stops. So
actually, yeah, we had Andy Home on last week, and he was explaining his thoughts on what had happened, who was involved. I think just before we get into this, that today we're going to focus on the events of last week. How do we take advantage of it? What are the actionable components? So first of all, why don't we kind of recap your thoughts on last week and where we are today?
Yeah, so not surprisingly, after that massive spike up where the price increased more than the prior high, within an hour, and things got shut down. Things have started up again, and while the LME was shut down, the Shanghai exchange was open through most of it. Now, again, given there was a major Chinese participant who was getting squeezed, I'm sure they got some help from some friends in terms of helping to manage where some of the prices were going. But fundamentally, as I said last week, I thought prices were going to end up in a $30,000 to $60,000 ton range, and prices have been going. The LME has set price limits where nickel prices can trade each day, and so we expect that to continue to tick down until we get into the low 30s, 1,000 a ton, which would be comparable to where the Shanghai exchange is today. Again, that's $14 to $15 a pound, and about 50% higher than where we were at the start of this year. So still a tremendous upside, versus where we've been trading.
What do you think the LME now needs to do? I mean, do they need to change? Do they need to modernize? Because even they were kind of caught short by the events of last week.
Yeah, no. When again, they are supposed to be the market of last resort, which should allow always price discovery to be to be there. But in nickel, there's two real fundamental challenges there. One is the proportion of global nickel supply. Particularly over the last last 15 years, with nickel pig iron being the bulk of the growth. In 2000, probably 80% of world nickel supply was deliverable to the LME. Today, it's probably about 30%. And so, part of why Tsingshan got into the problem they did was, they produce a lot of nickel, but they don't produce any of it in a form that can be immediately deliverable, to the LME, which is part of the reason, the banks probably let them run up the massive position what they did. So I think they're going to have to find ways to allow more different types of nickel products to become deliverable. And there are other products we see like aluminum alloys and other bits that trade. So I think that's one whole area that they're going to need to get to. And then the second part is just transparency. Again, they had put up, they started after the last sort of market disruption, they started disclosing people's positions once they got past a certain size, how many people had positions of a certain size in various bands, with, again, the view that someone can see someone, building a big long or a big short, someone on the other side is going to have to see it and make their trading adjustments accordingly. In this case, that wasn't the case. Tsingshan continued to have a massive short position, as, I think it's rumored that it was Glencore on the other side, who were squeezing them from the other side. And again, it was showed up in these LME banding reports, that there was one big person who held most of the outstanding warrants on the exchange, and it still happened. So I think it'll end up being, there'll be a lot more disclosure in terms of, what those positions look like going forward, so that, again, people can trade accordingly, and then again, maybe start to even look at limiting people from getting beyond a certain position unless there's some demonstrated reason why they, for their business perspective, need to do that. So I think those are going to be the two changes they're going to make.
And do you think that is, obviously we're talking specifically about what happened with nickel, but are you talking about a general behavior across all commodities, or are we very specific on nickel here?
No, this one is specific. Like the issue with product form, in copper and zinc and aluminum, literally 90% of what gets produced in those products is in a form that's generally LME deliverable. The product form issue is unique to nickel. The other one, in terms of people scaling up positions, is more broadly across the various metals. And we have seen things from time to time happen in them, but this situation, it was more unique to nickel, but that other disclosure will end up getting spread across all of the different metals.
Because I remember something similar with copper back in the 80s, wasn't it?
Yeah, there was a Sumitomo trader who
Sumitomo,
tried to corner the market at that time. Yeah,
yeah, young Charlie.
yeah, it didn't quite work out so well. So
No,
yeah.
I know. I know him. Sort of friend of the family,
Ah,
obviously. Yes,
wow.
heard the full story. Yeah, it's extraordinary. But I guess lessons were learned then. But obviously the events of the recent week have, I think, surprised a lot of people. Maybe we should talk about that. So, where do you think prices would go? And how do you position yourself to take advantage of the next phase of nickel?
Yeah. So in terms of positioning yourselves, like I think it's instructive to go back to the last super cycle. That's the one that we have the most data on. But again, I think is useful in terms of I'll talk about that one. But the same patterns emerged during the prior cycle. So so the last cycle was super cycle was 2001 to 2007. Prices went from $4,400 a ton to $54,000. That was more than a 12x move in a 5.5 year period. Again, not straight line. You had various peaks and troughs, and so again, expect the same pattern. This was a very pronounced peak that we saw. I don't know whether we'll fill in all the way back up to that number, but we'll start to build back up as we go through the next 2 or 3 years, which I think will be the tightest time in the marketplace. Again, with Tsingshan maintaining this big short position. You're going to see prices being very, very whippy. As much as the LME will allow them to be, you're going to see limit up, limit down moves. I think for the next 2 to 3 months, I've said that big earthquakes create big aftershocks, and that's definitely going to be the case here. And as I've been saying since the beginning of the year, Tsingshan's been overdue for their annual talk down the market, and so. If they're able to get any kind of momentum and prices down to the $30,000 a ton level, again, expect to see some announcements from them trying to take. Again, when you've got a 300,000 ton short position, you're definitely talking your book if you're trying to get that down. But the key thing here, again, all through all this is, and again, you're going to see some pretty nasty moves. So you're going to have some extra courage to hold your positions, through these time periods. But I mean, fundamentally, it's about growth in the EVs, and nickel demand from EVs on top of the stainless. And so, the next 3 or 4 years, as we go up the steep part of the S curve, and EV adoption is really where the opportunity is, from a nickel market perspective, and demand wise. The key thing for what happened in the last cycle from $2 to 24, there's obviously that's helpful to a bunch of projects in the short term. But the key piece of it is coming into that super cycle, the long-term price for nickel expectation was around $3 a pound. Coming out of it, it was close to $6 to $8 a pound. And all of a sudden there's a pile of projects that make, a lot more sense at $6 to $8 a pound than they do at $3 a pound. And so it's those two factors that you need to think about as you position yourself, to hopefully make a lot of money over the next 3 to 4 years.
Well, let's talk about that, okay? Because I think that's an important thing. Is and we've interviewed a few of those companies, which a couple of years ago didn't look so clever, a year ago didn't look so clever, but all of a sudden, everyone's a genius, right? So let's talk about positioning, because I think now is the time when you want to move away from probably some of the safer nickel stocks towards some more of the high torque names. Could be quite interesting.
Yeah, for sure. Because as we talked before, it was have some good safe nickel exposure and then have some sort of higher torque names. I think at this point, the safer names are the ones that most likely have run the most already through this first phase. What you really want to do now is move a little more of your portfolio into some of these higher torque names. Again, you're starting to get into super cycle when honestly, last week I heard CNBC mention the word nickel more times in an hour than I had in the prior decade. So, you're going to see a whole pile of new investors come into the space, that hadn't even thought about nickel 2 weeks ago. Before I talk about what you should invest in, I think there's a couple, strict cautions in terms of what you should not invest in this kind of a time period. So, first off, permitting and jurisdictional risk. What you don't want, this is now a 2 to 3 year window trade where, things are going to re-rate pretty dramatically during that time frame. And what you don't want is to get, have your investment in something that goes to a zero during that time period. And again, they don't have the time to correct themselves before you get out of this 2 to 3 year window. So, do your work, make sure that they're in a jurisdiction where they actually permit mines, where the community and everybody is still supportive of those mines. I mean, you don't want to toss your investment, get the cycle right, and then not make any money on it because you chose something that got wiped out because a local province or state or something or community made a decision that basically wiped out the money.
Okay, I mean that's a tough one, right? Because there's examples from all over the world where things go wrong jurisdictionally, at local level, state level, province level, federal level, because I don't know, NGOs, anti-mining groups kind of come in. So it's hard for us looking in and going, well, what does that actually mean? Because people talk about Fraser Institute, Australia, Canada, wherever, we're number one ranked for whatever. They all have good examples where companies have fallen foul.
Yeah. Oh, so, no, just this is one of those things where just do your work. Like don't look at sort of broad rankings or anything like that. Just very simply, if I'll just choose, if a project's in California, look to see in general, how many mines of any shape or form have been permitted in California over the last 3 years, 5 years, 10 years. How many projects came along, got shut down or tied up for 10 years. And, if the company's claiming, oh, we're different, really, be skeptical about, okay, are you really that different? Because again, most mines, you're generally digging a tunnel underground, or you're building a big pit, and you have tailings left over. So, there are some differences, but by and large, most mines are the same. So if they haven't permitted a mine in a decade, pretty good chance that they're not going to permit something anytime soon. And if there have been 2 or 3 projects that have got hung up, then you should avoid it like crazy. Again, I'm trying to use non-nickel examples, so I'm not picking on anyone. But if you look at Tesla invested in Piedmont Lithium, that they had a mine in the lithium belt in the southeastern U.S. Right now they're talking about building a plant in the United States, but that plant is now going to be supplied by spodumene from Quebec and Ghana, because they haven't been able to get local permitting for the mine to date on that one. So again, just go, this is one of those things that it'll take you an hour. You can Google the state, Google the province, Google the territory, Google the town, and really do your work to see, what's coming down the pipe. And again, see if there's any groups, even at an exploration stage, whether there's any community groups that are already gearing up, to fight the permit. It's not hard. Honestly, 1 hour per jurisdiction per company, and you should be able to come out with a good answer as to how much risk you're taking on that front.
Absolutely, it's an interesting one. I've actually spoken to a couple of companies this week who have not filmed on camera, but have pulled out of projects where they were based because of the local opposition. I thought that was quite interesting. And another one who kind of forgot to tell me that their mine was bordering on a town. It's only when I looked at the Google map where I was like, oh, hello. There appear to be 10,000 houses to your east.
Over top.
What's that going to do? And sure enough, we've seen that in Europe a lot, with some of them, companies hoping to mine in Europe in reasonably residential areas. They didn't go ahead. So it can work, but check is what you're saying. So what about technical risk in there?
Yeah, no, that's the other area. Again, in a super bull market, you can that people will see this through the technical risk on a lot of projects. Again, if you just look back when cobalt prices spiked 3 or 4 years ago, a bunch of companies with HPAL projects in the West, which had a very checkered track record, those prices all moved up, pretty dramatically, along with cobalt prices. But, if you see where they're trading now, you'll see you would have given up most of your gains, because again, they're still technically challenging. So I would say, again, you can take some technical risk, but be extra cautious. and be quick on the trigger in terms of realizing your gains, because again, you don't want to find out that, oh geez, they get to a certain point and don't blow up, or because the companies know that if they get to this point, it's going to prove out that they're not right, and then the market will punish them because they're not moving quickly enough to take advantage of this spike.
Yeah, it's kind of interesting. I'm thinking when you're talking there, I'm thinking AMC's investment in Highcroft Mining. That'll be interesting because we spoke to a company that Highcroft had licensed their technology out to, who were due to be showing that the technology worked in Q4 last year. Didn't kind of happen because the technology was obviously, it wasn't so conventional. I was saying this to one of the to someone that this morning, who one of our members who's sort of intrigued about what you look for, and saying that we kind of veer away from new technologies unless they're we like a proven technology. Technology risk is huge, no matter how clever people say they are, until it's actually working at commercial levels. It's not a risk. There's too many good projects looking for too much money out there for me to waste time on something which has a potential technical chance of falling over. Because mining's hard enough without having to crack the code, as it were.
For sure. No, every commercial disaster was a raging success at a pilot plant stage, right? So the point that you had made, that unless it's proven at a commercial production level, you are taking on some risk. And then the third piece of this, again, the key piece is you're going to be in this very exciting, very steep price move for 2 or 3 years. It will not last forever. When you get towards the peak in 2006-07, there was the number of nickel transactions that was done within 8 months of the peak was absolutely eye-watering. Again, and it happens every cycle. People could have bought stuff for 1/10 the price at the beginning of the cycle, and they don't decide to actually pull the trigger until the price is within a few months of the top. Again, unless you're doing detailed commodity work so that you understand where that top is coming, just be cognizant. If you've made 3, 5, 7x, during that time frame, take your profit. Don't try and time the market too closely, because in nickel, again, every big company did a pile of deals at that time with extensive market research departments, with very smart advisors, and most of them, got it horribly wrong. Again, I was in a fortunate position that, that's how I was doing, doing the commodity work. And so, part of the reason I left Inco when it got taken out by Vale was to go short nickel in 2007. And so, and made a lot of money doing it at that point in time. But unless you've got that kind of commodity research stuff, don't try and time it too cutely in one of these, one of these super cycles. It's a great chance to make a lot of money, and you don't ride the roller coaster over the other side, because it can be very scary.
It's basically, I was having the same conversation this morning with this member, which was just that. Get your initial capital out, right? Yep. Get it as quickly as possible, because and it's cliche. It's hard to time the bottom. It's hard to time the top. No one in the world can do it perfectly every single time. It just doesn't happen. Some people do it by mistake, and they look clever in one instance, right? And they'll tell you about it. Oh yeah. So don't worry. It's a great story, but you making money or not making, you not making as much money as the guy who's telling you all about it, doesn't matter. If it hits your threshold of, well, I got my money out, so I haven't lost any money, brilliant. And then keep taking your money off the table, because timing the top is difficult. Just be happy that you've been able to walk away with a gain. I think Ferg does a couple of fantastic sessions in terms of how to exit. So go back to those and have a look. But I totally agree with that. So that's what to avoid. So the permitting, jurisdictional risk, technical risk, and remember to take your money off the table, because you ain't made money till you've cashed in your shares. Okay?
Your money's in the bank. It's just right. Exactly. Yeah. I haven't seen those sessions with Ferg, but I'll watch them because again, exiting stocks is even more important than getting into them. So, for that very reason. So
exactly. Paper gains are nothing. Paper gains are nothing. You could be a paper millionaire. Once the money's in the bank, you're not a millionaire. So maybe should we look at maybe some of the things that you think might outperform?
Yeah. So the tricky part is, again, unlike copper and zinc, where you've got lots of opportunities in all the different buckets. In nickel, part of the thesis is there isn't a lot of supply lying around to come to market. So but there are some really good. So one of the first categories that participates in this kind of a run is a past producer restart. So the companies that have done well during the first leg up are existing producers. So people go, okay, I know they've got their cash flow now. They're generating a lot more cash flow. I'm very glad to participate in that rise in the cash flow. The next bucket down in the chain, where people will start to look after we've gone through one of these spikes, are past producers. So those companies that have mines that did operate at one point in time, that have been shut down because prices are too low for them to make money, and then they're able to bring that production to market. So companies like that are Mincor in Australia. Poseidon is another one, and they benefit. They are also uniquely positioned in that, in these situations, that when you don't even have your own mill, all you do is basically dig ore out of the ground, and in this case they ship it to BHP. The terms that BHP buys it are highly favorable to BHP. But in this case, when everyone's making so much money, you don't mind giving up a third of the revenue to the people processing it. So, if you go back into 2005, 6, 7, when Mincor was there, they were producing a substantial amount of nickel, and you can look at the market cap at that point in time and kind of get a sense of what the upside can look like. And they have made a new discovery, that they're bringing to bear. So, that those Aussie companies, none of them are particularly cheap. But again, do your work. But in a much stronger price environment, they're just going to rain free cash flow down from those assets, because it takes very little time and very little capital to get them back into operation, and there's zero technical risk because these things have operated on and off for the last 50 years. Outside of Western Australia, the only part really is there's Magna Mining in Sudbury. Now they're looking to build a mill. They do have the option of just digging the ore out and shipping it to Vale or Glencore. And given that both of those operations are pretty desperate for feed, generally they screw over anyone who has to provide them feed. But in this case, they're, I think, pretty keen. They've got a lot of capacity to be able to process ore. So that's one place that would be good. And the other place is there's some mines down in Botswana. I know there's somebody looking to get them restarted. But again, I think those are larger capital, larger lead time type restarts, which are going to be more expensive to get going. But this whole past producer restart is definitely a category that you want to look at in terms of who can come to market.
Yeah, and again, just be careful, guys. Here, again, as Mark said, it pains to say, do your homework, because there's a lot of past producer restarts which will be good, and there'll be others where the management team really are just trying to jump on the back of the wave here, and I'm perhaps not equipped to actually make it work. The asset may not be good enough. So just do your work. We've spoken to a few sort of restarts, and I think some which are obvious winners because maybe not fit for BHP or Rio anymore, but they're good for a junior miner that absolutely perfectly adequate, will produce cash. And there are others which are just never going to work. But
no. Yeah, those three companies I mentioned all have management teams that have operated mines and have the capacity to do it, and that's a very, very good point. Now, there's lots of people, again, just because they said, oh, this operated from 1968 to 1972 for 4 years. That's the next point is then look at the people, and if they've actually never built and operated a mine, then tread extremely carefully.
Yeah, 100%. And so what about some of these, something dear to your heart, what about some of these large lower grade deposits? People, still get people confused or concerned about, the viability of them. What's your thoughts?
Well, the one before I get there, just the other ones that are sort of near-term cash flow things are the development stories. So again, in nickel, there's not very many, but the one company that is under construction right now is Horizonte. So
Oh, yeah.
Ferronickel operation in Brazil, technical risk wise, again, relatively low. It's not a complicated process. We'll see capital and operating costs where they come out, but the nice thing with when you've got development stories in this kind of a cycle is they typically were sort of got the go ahead at a much lower price, and so the sharp increase in prices is just going to generate a huge amount of incremental cash flow versus the original project assumptions. So those, and again, in nickel, normally in a lot of metals there might be more than that, but with nickel, that is really the only kind of new go ahead project that's there. And then the other bucket is new discoveries that could be advanced. So Centaurus in Brazil, definitely it's an open pitable resource in a jurisdiction that you can get mines permitted and developed pretty quickly. So again, they're one of the only ones that have any scale at this point, and in a jurisdiction that can get going. There's lots of stuff, and it's open pitable. There's some smaller high grade things that people have been finding, but I don't think anyone's put together a decent resource at this point. And then coming back to the large low grade. So the other place that you really need, and this is when the shift in the long-term price happens, that I talked about. So again, in the 2001 to 2007 cycle, long-term prices went from $3 to $6 a pound. And, that transforms the economics on a bunch of different projects. Unfortunately for nickel, and it's not as evident in terms of how you should think about it, because in nickel, the big winners on that one were the laterites in Indonesia. So those were either private Chinese companies or private Indonesian operations that own those assets. So if you could have bought Tsingshan as a public company in 2005, that literally would have been 100-bagger, over the next 15 years. But we didn't, because they're a private company, you didn't have access to it. And there's several other Chinese companies, again, that, over that time frame, would have been 100-baggers, during that time frame. So we didn't get to participate as public investors in that last move. The thing here is, I'm a firm believer, and not just because I own Crawford, which is one of these large, low-grade ultramafics, because that are made up of rocks that spontaneously absorb CO2, which is a very valuable thing in today's market. There's a bunch of deposits. There's some in British Columbia. So you've got FPX and Giga and Innimin and Nickel Creek Platinum. Those are all part of a set of structures that go from British Columbia all the way up into the Yukon. We should be able to find some of these in Scandinavia, in Finland and Sweden and Norway, and there might be some emerge, in West Africa as well, because they have the right age rocks when, again, the mantle was able to come up and get high enough up in the Earth's crust to be able to find them. So, these to me are the new class of deposits that are going to go through a significant re-rate as we go through this super cycle.
It's interesting times that I think you and I had that conversation with regards to the kind of net zero component of your project. And I'm sure there will be others, but the sheer scale of that. How does the market start to value those things, or when do you think the market starts to value those things? Because I don't think that's going to factor, certainly not into Crawford pricing at the moment. But what's it going to take to do that?
No, and generally this is typically where you see it happen, and I think this is the opportunity now. Is after you've had one of these big price spikes, and if prices settle out in this sort of $30,000 a ton range, and people go, oh, okay, nickel prices are going to be at $30,000 a ton for a while versus where they were at 20. Maybe I'm comfortable now with a long-term price. We used a price of 17,000. And most of the pre-fees feasibility studies done for these deposits were all done, somewhere between $16,000 and $20,000 a ton. If now people can start to use $20,000 to $22,000 a ton as a long-term price, because nickel prices have stayed up north of 30,000 for a while, and people realize, okay, we are still seeing very high demand growth in the EV sector. So I think it's during the course of this year, as 2022 unfolds, and people realize, prices are going to be higher for longer. We do need new projects to be able to help fill the supply demand gap. And then people start to look and say, oh, this project with $22,000 a ton nickel, it's worth $3 billion or $4 billion. That's the kind of mind shift that happens, in this current phase of the nickel price cycle that we're seeing.
So do you think people are starting to understand these ultramafics like you have at Crux? You think that's it's an easier conversation to have these days than it was?
Yeah, they already are, and it's going to be heightened by this time period. Because the thing is, when you're on the first leg of one of these super cycles, the challenge is we came off a base of about $9,000-$10,000 a ton, and so in that first move up to 20, people still go, well, we were just $9,000 or $10,000, 18 months ago, 2 years ago. Who's to say it won't go back there? Maybe I don't believe how quickly certain stories are going to unfold. So again, there's a recency bias all the time with things. And so, in that first leg, you don't see these types of stories typically re-rate. It's in this next leg where we are now, where we came off a little bit and then we went to, again, a much bigger spike than you would have normally done, but you would have seen a big spike anyways. And now that the prior bottom was $20,000 a ton, and we're now in the 30s, people go, oh, okay, I can get comfortable with a $20 or $22 or $25,000 a ton long-term price, and oh, what would these deposits be worth in this kind of environment? And again, particularly with the zero carbon aspect of all of these ultramafics, I just think is going to be people figure that out over the next year. Should be pretty exciting.
Yeah, it should be. And then I guess with obviously what's evident that this week is that people are looking at nickel and trying to understand it a little bit. Is scale, because we are, if the EV manufacturers, the OEMs are to be believed, they are getting a little bit nervous. Yeah, we've talked about substitution of substituting nickel out in some use cases, and people go, oh, well, is that the end of nickel? Is it? Well, no, the OEMs are very much firmly, and the battery manufacturers are firmly saying is there's just not enough. Where's it all coming from? Where's the district scale exploration, development, production going to be happening? I mean, thoughts on that? Are we going to have enough nickel?
Oh, it'll be a challenge for us to get there. And what I said before, again, the car companies were going to price their mid-range cars between an LFP option and a nickel option to help manage the amount of available supply, to manage the demand to the amount of nickel that's actually available. But what it does mean is prices, will be higher for longer. And what they want, again, what's attractive of these deposits is the scalability. In an open pit environment, you can buy more trucks, buy more milling equipment, and you can produce more nickel. In an underground mine, again, we're looking at Voisey's Bay underground and Onaping Deep, which is Glencore's development asset in Sudbury. They started sinking a shaft in 2018, and they won't be fully ramped up until 2023. That's not the kind of time frame that companies want to look at in terms of getting things into production and being able to expand them. So that's why this class of open pittable deposit, we just think I think is going to be highly attractive to a bunch of participants in the supply chain who want to see an increasing supply of nickel available to them over the next 10 years as they ramp up their EV businesses, which again, all the car companies, EV, for Ford, GM, Stellantis, Volkswagen, Fiat have all said, are key to their where they're headed going forward.
I mean, what are the conversations that are, I don't know about you, but we've been sort of attending more of these conferences and just listening to the mood and trying to work out who's moving. Obviously, we talked about Noront previously with BHP and Wiley's situation, and we've seen both Rio and BHP getting out the checkbooks across the metals sector on projects which are much smaller than they would normally go for.
Yeah,
they're getting nervous about where's it come from, and then the mid tiers too have been getting their checkbooks out. We've seen little bit of action there in Canada with you guys on the precious metal front. So, do you think specifically to battery metals and that, and nickel, obviously, we will see a lot more M&A action this year? And are people going to have to? Are those companies, right, with the check rates having to lower their standards somewhat?
Oh, in 2022 and 2023, yeah. We've already seen, in my view, a surprising amount of M&A activity, given it's still relatively early in this cycle. And so, I think every company that has any decent nickel deposit, if they haven't been able to keep their share price at a point where it becomes eye-wateringly painful for a major to take them out, they will disappear during that time frame. It's just there's very few good projects of any scale that are out there. All the ones that have gone so far are projects that have been around for 10, 12, 15 years or longer. In the case of Kabanga, with BHP making their investment there, they will, the newer deposits and newer stuff, they will get that figured out in the next year or two. So they're already getting it figured out. They're going to grab everything that they can. So it'll be a bit like nickel in 2006-07, which kind of turned into a feeding frenzy. I think you'll see another one of those emerge in the next 24 months.
Well, look, that was a good run. We haven't seen you for a bit because I know you've been busy and various roadshows and conferences and talking to everyone. So it's a good catch up from that point of view. And I know you were a little bit poorly as well. So I appreciate you making the time to come and see us. This is the weekend garb. It's a little bit more relaxed. You're always
a little
relaxed,
more. I'm always
totally
relaxed. So no, I think again, this is one of these super cycles don't happen very often. So I'm keen to sort of help people in terms of getting themselves positioned for to be able to take advantage of it. So as I said, I think the next couple of years in the nickel market here are going to be pretty interesting.
And as always, I think what you've demonstrated today is, as you've always said, is we need all of the above. So I'm happy to talk about other companies, the good ones anyway, as well. So appreciate that, Mark. Look, we'll hopefully see you next week. I'm glad you're feeling better.
Most definitely. All right, sir. Take care.